5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to another episode of the Follow the Money podcast. My name is Jerry Robinson. Today's program, episode number 512, we are entitling Trump Accounts Explained. So we're going to be talking about this brand new savings and investment option for children called the Trump account. The online election process is actually now available. Families will be able to begin funding these accounts on July 4th, 2026. It's a brand new account that's been put out by the federal government. Certain eligible children may also receive a one-time $1,000 contribution from the federal government, and naturally, that has a lot of parents and grandparents asking questions about who qualifies and how do you open one. And what can the money be invested in? And how much can the family contribute? These are obviously important questions because the account you choose for your child can influence how money grows and how it's taxed and how much flexibility the child is going to have later in life. So in that first segment, I'm going to explain how Trump accounts work, where I believe they may be a good fit, and why I still want families to take a very close look at the kid Roth IRA once a child begins earning legitimate income. We'll also talk about the long-term tax picture because many Americans reach retirement with most of their savings sitting in tax-deferred accounts. That obviously can create some challenges later, especially with withdrawals becoming taxable, and then you have your required distributions beginning. A child who starts early may have an opportunity to build money across several different types of tax categories and then enter adulthood with a lot more flexibility. And then in our second segment, we will turn our attention to the financial markets. I'll share my latest market insights. We'll look at some charts together. I'll talk about some key levels I'm watching right now. And then finally, we'll close out today's program with a few thoughts about the kind of financial inheritance we're leaving to the next generation. We have a lot to cover. So let's begin with our main topic today, Trump Accounts Explained. Let's get started. All right, friends, let's get right into our main topic today. That's Trump accounts. As I mentioned, the IRS online election process is now available. Contributions to these accounts can begin in just a few days on July 4th, 2026. It's a big 250th anniversary for the country, and the Trump administration is putting out a new type of account. Now, we're going to break that account down today, see if it means something good for your family. We're also going to compare Trump accounts to, say, kid Roth IRAs, which I'm a huge fan of. But of course, there are stipulations on that. So obviously, there's been a lot of interest, though, in these Trump accounts, especially because the federal government will provide a one-time $1,000 seed contribution for certain eligible children. Obviously, parents and grandparents want to know how all this works. Who qualifies for the $1,000? How much can a family contribute? Who controls the account? What can the money be invested in? On and on and on. There's all kinds of questions. And then, of course, we're going to also address how does a Trump account compare to a Roth IRA for a child? So I want to walk through all of that today and then give you my own practical view of where these accounts may fit. Let's begin with the basic structure of these Trump accounts. A Trump account, let's just define it. A Trump account is a special type of traditional IRA. That's an individual retirement account. It's established for the exclusive benefit of a child. Now, the child is the owner of the account, although an authorized adult will serve as the responsible party while the child is a minor. Now, that adult can select among the eligible investments and handle the account's administration during the child's younger years. Now, there are two different eligibility questions here. It's important to look at them. The first question is whether a child can actually have a Trump account established. Generally, from what I've read, and I've kind of done a deep dive into this here, an account can be established if the child is under the age of 18 at the end of the year in which the election is made, and also has a valid Social Security number issued before the election, and has not already had a Trump account election filed on his or her behalf, right? So you got to be basically under the age of 18. You need to have a valid Social Security number. And as long as you haven't already applied for one of these, that should be fine. Now, that means the Trump accounts are not limited only to children born during the 4-year federal pilot program. And that brings us to the second question of whether your child could qualify for the one-time $1,000 Treasury contribution. Now, in order to qualify for that $1,000 contribution, the child must have been born in 2025, 2026, 27, or 28. Basically the 4 years of the second Trump term, right? So the child must be a U.S. citizen, must have a valid Social Security number, and again, cannot have had a previous program election processed. And of course, the person requesting the $1,000 must also anticipate that the child will be his or her qualifying child for the tax year in which they make that election. In most cases, that's going to be the parent or the guardian. Now, to make this election, you're going to use IRS Form 4547. You can submit the form through the IRS online process with an electronically filed tax return, or you can do the old paper form and submit it that way. Now, for the online process, you'll need an IRS account. You'll need a way to identify yourself. The IRS prefers ID.me, so you'll need an account there. And then, of course, you'll need the child's Social Security number, birthday, and address. And once you submit the election, then you can just return to the IRS account and just keep checking on its status to see whenever it's approved. Now, as you can imagine, as I mentioned, that headline that has attracted the most attention is that $1,000 government contribution. So for a qualifying child, the Treasury Department will deposit that $1,000 into the child's Trump account after the account has been opened and the election has been processed. And so the very first thing that I want to share with you is that if you know anyone who is pregnant right now, if you have any pregnant friends right now, any families that you know are getting ready to have babies or who had a baby recently, maybe in 2025, after January 1st, anytime in 2025 or in 2026, or if you're planning on having a child between now and the end of 2028, then this is a big deal because it's a free $1,000 contribution that you simply have to go through the red tape to get. And I think it's absolutely worth it, right? So that's the first thing is that, if you are pregnant right now or you're planning on having a child within the next year or two, do not forget about this and tell all of your friends who are preparing to have a baby, who are recently had a baby. They can go back and listen to this episode, or you can just tell them more about the Trump accounts and how they can request that $1,000 seed to be placed in their child's Trump account. And what I really like about the idea of all of this is that we're getting children started early with investing, right? It's a huge thing. It's a very big thing. Anybody who started investing in their 40s or their 50s, you know the power of being able to start earlier. Maybe you got started in your 30s. Imagine getting started before you were 18, right? That's the power of these kinds of accounts. Let's talk about what that $1,000 government seed could eventually become. I ran a simple calculation that said if $1,000 were invested when the child was born, right, and then it earned an average annual return of, say, 10% for 65 years, what would that $1,000 grow to? You might want to sit down, but that $1,000 over 65 years compounding at an average annual return of 10% would grow to approximately $490,000. That's close to $500,000 from a one-time initial contribution of $1,000 when they were born, right? That's incredible. That will be an amazing way to help your child or your grandchild in the years ahead. Now, that obviously is a calculation, and that calculation is just an illustration. No one can guarantee a 10% return over the next 65 years. There's going to be recessions and bear markets and changes in interest rates and changing tax laws and inflation and et cetera, et cetera. And there'll probably be long stretches of time during that span where investors may question whether the market is really going anywhere. So the value of this illustration here is really the length of time involved. $1 invested for a newborn may have 6.5 decades to compound before they begin to touch it for retirement. Most adults never have an investment horizon that long, right? By the time many people become serious about retirement, they may only have 10 or 20, maybe 30 years remaining. But a child has an advantage that you just simply cannot recreate later. That advantage is time. So while the child is growing, it's not going to require any kind of concentrating or finding the next great stock. It simply requires regular ownership of productive assets, low expenses, patience, and the discipline to leave the money invested, which can be easier said than done, of course. But that federal contribution of $1,000 is just the beginning. You see, parents and grandparents, friends, employers, government entities, and qualifying nonprofit organizations may also contribute under the rules. And what's really great about the Trump account is that during the child's growth period, personal contributions can generally be made even when the child has no earned income. That's one of the biggest differences between a Trump account and, say, a Roth IRA for a child. Now, most private contributions and qualifying employer contributions are subject to a combined annual limit of $5,000 for 2026 and 27, and that limit will be eligible for inflation adjustments after 2027. Now, that one-time $1,000 federal contribution does not count against that $5,000 limit. But families do not have to contribute $5,000 a year for the account to be useful. A grandparent could contribute $250 or $500 a year to that account, and parents might establish like a monthly contribution. Birthday and Christmas money could be divided. This is what we do at home. Whenever our kids have birthdays or during Christmas time and they get money, we divide that up between what they're going to spend, what they're going to give, what they're going to save, and what they're going to invest. And that investing portion or even the savings portion that they don't need right now could also go into that Trump account. Because the truth is, even small, modest contributions can accumulate over a long period of time. So that's all the good news, right? If you have a child between 2025 and 2028, you really just need to get access to this $1,000 seed money for your child. This is kind of a no-brainer. But there are some buts here. Let me talk about one of the biggest limitations involving this Trump account, and that involves the investments. So during the growth period, this Trump account cannot be invested in anything that the family chooses, right? The investments are generally going to be mutual funds or exchange-traded funds that track a broad index made up primarily of American companies. So in other words, during that growth period, you cannot use the account to buy individual stocks, right? You can't buy Bitcoin or other digital assets. You can't use options. You can't use leveraged ETFs or private investments. So some experienced investors are going to view those rules as pretty restrictive, and I understand that concern. Many of us prefer having the ability to choose our own investments. Still, a broad, low-cost stock index like the S&P 500 may actually be a really sensible foundation for a child who has 40, 50, or 60 years still ahead of him before he begins to touch that money. You should also know, too, that the money is generally unavailable for withdrawal during the growth period. And so the growth period lasts until December 31st of the calendar year before the child turns 18. So beginning January 1st of the year in which the child turns 18, most of the ordinary traditional IRA rules begin to apply to the Trump account at that point. So there's the basics of the Trump account. And it sounds like a great plan. But now let's compare the Trump account with a kid Roth IRA, which, by the way, is one of my absolute favorite ways to help a child begin to invest. So a child can contribute to a Roth IRA only, and this is very important, only when the child has legitimate earned income. See, that's the big difference between the Trump account and a kid Roth IRA. The contribution cannot exceed the child's compensation for the year, and it's also subject to the regular annual IRA limit. So let's use a simple example. Let's suppose that you have a teenager who earns $3,000 through a summer job. Maybe he mows lawns, or maybe he cleans pools, or something along those lines. Well, the child, in that case, may be able to contribute as much as $3,000 to the Roth IRA for that year. Now, that contribution does not necessarily have to come from the same dollars that the child earned, right? The child could keep some of that paycheck for current needs, while a parent or a grandparent could provide the money that goes into the Roth IRA. But the point is, the contribution simply cannot exceed the child's qualifying compensation for that year. The work and the income need to be real. And it could really be anything. It could be a traditional part-time job. You could be doing lawn work, babysitting, freelance work, or whatever. Maybe even working in the family business, as long as it's reasonable and necessary work. It's very smart for families to keep records on that stuff and pay reasonable compensation, report the income correctly. So here's the deal. When a child has legitimate earned income, I generally prefer looking at the Roth IRA first, right? Why? Because Roth contributions are made with the after-tax money, and the investments can grow tax deferred, and then the qualified withdrawals made later in life can be completely free from federal income tax. I mean, using our example of that teenager who may have 45 to 50 years before reaching retirement age, that's going to create an unusually long period for tax-free compounding. Consider a teenager who contributes $1,000 per year at age 15, 16, 17, and 18, right? That's $4,000 in total contributions. And let's assume we're putting this into that kid Roth IRA as opposed to the Trump account. Now, again, assuming an average annual return of 10% and no further contributions, right? Just $1,000 per year made by the teenager at age 15, 16, 17, and 18. That's $4,000. Those 4 deposits of $1,000 into a kid Roth IRA could grow to approximately $400,000 by age 65 if we assume that same average annual return of 10%. But get this, if the teenager contributes $3,000 during those same 4 years for a total of $12,000, the illustration grows to approximately $1.23 million by the age of 65. Again, those are hypothetical illustrations using a 10% average return. Obviously, your actual investment results are going to vary. But the larger point here is that contributions made during the teenage years have several additional decades to compound compared with money invested later. A Roth IRA also begins building a source of potentially tax-free retirement income. As I've said many times, many Americans eventually reach their 50s and 60s with the majority of their retirement savings inside of traditional 401ks and traditional IRAs. And it's understandable because those accounts are most often pushed upon us by our HR departments and also by financial advisors, and they provide valuable tax deductions during the person's working years. But the tax bill was postponed, so withdrawals from those accounts are generally taxable as ordinary income. Later in retirement, those required minimum distributions, those pesky RMDs, may force money out of those accounts, and taxable distributions can also affect how much of a person's Social Security benefits are taxed and may contribute to higher Medicare-related costs. Now, if you think like me, you expect that tax rates are going to have to go up. If you look at the national debt, you know it's sitting near $40 trillion. The government has no plan. They're spending money like drunken sailors. And no one knows exactly what federal tax rates are going to be 30, 40, 50 years from now. But if I had to guess, I would have to say higher, right? I think tax rates are going to have to go up. In fact, if you look at current tax rates now, they are, believe it or not, among the lowest in recent history. It's hard to find a lower tax regime than where we are right now. So taxes, as they say, are on sale. That's why we like the idea of doing Roth conversions for people who have a lot of money in that traditional IRA or traditional 401k bucket, and you can begin doing that in your 50s and slowly paying the tax bill now so you don't have to pay it much later whenever taxes inevitably go higher. But now getting back to that, kid Roth IRA, the young person who gradually builds money under different tax treatments is going to have much more flexibility when he gets older or she gets older. Now, a Trump account can begin the tax-deferred portion of the plan, kind of like a traditional IRA, and a kid Roth IRA can begin building the tax-free portion once the child has earned income. Now, you also might want to think about a regular brokerage account, which may provide flexible money that's not locked inside a retirement account, which may be very useful. And also a 529 plan may be the better choice for money intended primarily for education. You see, families don't have to use every type of account. The goal is to understand the purpose of each one and then to choose according to the child's situation. So for a very young child with no earned income, the Trump account provides an opportunity to begin investing in a tax-advantaged structure. Very, very powerful. But once the child begins working, a Roth IRA may become the better destination for the next retirement dollar. For families who have enough resources, I think taking advantage of both might be wise. Now, there is also a very important planning opportunity once the Trump account growth period ends. And we wrote an article about this. We just posted it on followthemoney.com. We'll provide a link to it in the show notes, which goes into this deeper. But beginning in the year the child turns 18, that Trump account is generally governed by the traditional IRA rules. Those rules include the ability to convert money from the Trump account into a Roth IRA. And that's where this planning opportunity really comes into play. You see, an 18-year-old may have relatively little taxable income, and he's been having money put into this Trump account over time by parents, grandparents, and of course that initial $1,000 seed if he was born between 2025 and 2028. But as an 18-year-old, he or she may have relatively little taxable income. The same may be true during the college years or during the first few years of the young adult's career. And here's the point. Those lower income years may provide a very attractive window to do a Roth conversion. This would allow that younger person to be able to pay the taxes early while they're in a lower tax bracket and get it out of the way, and then basically have that money in a Roth IRA that they can then tap tax-free in retirement. Now, I won't go into all the tax rules. I'm certainly not a tax advisor. You'll certainly want to talk to a CPA or a trusted tax advisor about how that Roth conversion is going to work. And as I mentioned, that conversion may be very attractive during a low income year for the child or the young person, the young adult. It may also create a larger tax bill than expected if the family assumes the whole conversion will be tax-free, right? That's why families should keep the account records and revisit that strategy before the child reaches adulthood. So if you're setting up one of these Trump accounts for a young child today, what I would do is just place a reminder in your financial plan to review it again once the child is 16 or 17, and then begin looking at a smart strategy to do a Roth conversion with that money so that you're able to provide tax-free retirement dollars for that young adult. As they get older, they will be very, very grateful for that, especially with taxes set to go higher. So here's my practical takeaway. If your child qualifies for the one-time $1,000 Treasury contribution, I would take a very serious look at completing the election and getting that $1,000 into their Trump account. I mean, for a young child without earned income, the Trump account may provide a useful place to begin long-term investing. And when the child begins earning legitimate income, take a close look at opening and funding a kid Roth IRA. In many cases, the Roth would be my first choice for new retirement contributions because the potential for tax-free qualified withdrawals later in life. Of course, if education is the primary goal for the savings, you can also compare those accounts with 529 plan and see which one is better for you. And of course, if you need flexibility and you don't want to lock up the money, well, then consider whether a custodial or a regular taxable investment account like a brokerage account may also belong in the plan. The point is, different accounts solve for different problems. There's not just one best account. Different accounts solve for different problems. I also want to encourage parents and grandparents to use these accounts as financial teaching tools. This is so powerful. We do this with our own children as well. Show the child the account statement and explain what the index fund owns. Show how a $25 contribution buys a small ownership interest in hundreds of American companies. When the child receives a dividend, explain what they are and talk about why stock prices rise and fall. Explain why investors continue buying during difficult markets, and show the child what happens when the account receives another year of growth on top of the growth from previous years. You may find that education can stay with the child long after the money is spent. Now, if you're like the average person, you might want some help comparing a Trump account with a kid Roth IRA or a 529 plan or some taxable investment account, or maybe even a future Roth conversion strategy. And if so, you can request a complimentary conversation with a Follow the Money affiliated advisor. Just go to followthemoney.com/advice. And one of our affiliated advisors can help you review your child's age and earned income and tax situation, your education strategy, your long-term goals, and then help you determine how these accounts may fit into your broader family financial plan. All right, coming up next, we're going to shift our attention to the financial markets. I'll share my latest insights, some of the key levels we're watching on some of the major markets. We'll be right back. Hold tight. Hey friends, Jerry Robinson here from followthemoney.com. Before we continue with today's podcast, let me just mention something really quickly. If you've been listening to the podcast for a while and you're starting to think more seriously about your own situation, your investments, your retirement plan, and how everything is actually structured, there comes a point where it helps to talk it through with someone. And that's why we created our Follow the Money advisor referral service. We work with a network of trusted financial professionals across the country, and we can connect you with someone who can help you take the next step, whatever that looks like for you. Maybe it's reviewing your current retirement plan, or maybe it's putting a real income strategy in place, or maybe you just have a simple question like getting a life insurance quote. If that sounds helpful, you can learn more at followthemoney.com/advice, or just give us a call at 800-609-5530. No pressure, just a chance to get some clarity around where you are and where you're going.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on the planet. You're listening to the Follow the Money podcast. My name is Jerry Robinson, founder here at followthemoney.com. That's where you can find us online if you want to learn more. We have lots of free resources for you, a podcast, a YouTube channel, lots of articles that we've done over the years, but our members get a lot more. Simply go to our website and learn all about it. Now, today, what I want to do in segment 2 is I want to get into some of the latest market insights that we have been sharing with our members and also just kind of paying attention to. The market has been a little erratic lately. Right now, the Federal Reserve is basically penciling in, if you look at the Fed funds futures market, about a 60 to 80% chance of a rate hike by September, October, somewhere in the fall. Right before, by the way, the midterm elections. Wouldn't that be interesting if that actually happens? I'm not so sure. However, when we take a look at the inflationary pressures we've been seeing, they are elevated. Inflation is growing at about a 3-year high right now, and that is putting pressure on the new Kevin Warsh-led Fed to raise interest rates later this year. Of course, that's the opposite of what the Trump administration has been asking for. They want lower rates, of course, as we head into the election. We'll be curious to see who wins that battle. But regardless, right now, the markets are beginning to price in that rate hike, and that's why you've been seeing quite a bit of flux in the markets, especially in the U.S. dollar. The dollar has been on the ascent. It recently broke out above 101, the U.S. dollar index. If you follow that chart, you know that once it goes above 101, that we could see a bit more in terms of a rally. Now, I'm thinking that we're probably going to see resistance around that 102 level. And if we do, that could lead to a relief rally or spark a relief rally in things like gold and silver, which have been pulling back. In fact, as I record this broadcast on Wednesday, the 24th of June, the price of gold is sitting right around $4,000, which is the lowest level we've seen since late March. And silver has fallen below the $60 level. It's currently trading around $58 or so. So we've certainly seen a big pullback in those two markets. But much of that has happened since the beginning of June, where we began to see that U.S. dollar begin to rise in anticipation of a likely rate cut later this year. So on that dollar, I'd be watching about 102 on the upside. If we break through 102, that could signal even more pressure to the downside on gold, silver, and a few other commodities, and even certain areas of the stock market. Now, if we look at the S&P 500, that's the biggest market for equities here in the United States, certainly the most closely watched index by the globe when they look at U.S. stocks. The S&P 500 is sitting right at its rising 50-day moving average. Remember, it broke out above its 200-day back in early April after we had a dip down to around 6,300. Well, it's since rallied back above its 200-day and its 50-day, and it rose to nearly 7,600. Now it's pulled back just a little bit, and it's sitting at its 50-day moving average. This is often where you'll see a rebound in a market. So the market has pulled back a little bit. It's sitting below its recent highs, and it may be due for a bounce. Although I will tell you that there is still a lot of uncertainty surrounding the end of the Iran war. We have heard that the Strait of Hormuz is letting ships through. We do have an understanding that there has been a peace deal achieved with Iran, but there's still a lot of uncertainty there. And as we well know, things could change overnight. But you can certainly see that the markets believe something about peace by looking at the price of oil. So the price of West Texas Intermediate just back in May was well above $100. This month, it's down to $70. So we've seen a very sharp decline in oil prices. Brent crude was up above 110 per barrel back in May. Now it's down at about 74, right? Even gasoline prices have begun to come down. In fact, the average price of gasoline in the futures market has dropped about $1, almost $1, over the last 6 weeks or so. That may not be translating into pumps, and maybe it is in your area, but regardless, we have seen those prices also come down in the futures market. Now, when we look at the S&P 500, again, that really is the area that you want to be watching if you're trying to figure out which way stocks might go, because 3 out of 4 stocks follow that index in terms of trend. And if you look at the breadth of the market, tech and energy are still the big leaders this year in terms of the sectors. But overall, 63% of stocks in the S&P 500 are trading above their 200-day moving average. That's bullish. So we are still seeing good participation across the board with many of the sectors. There are a few laggards this year. Communications, for example, that sector has been hit pretty hard. If you look at the NASDAQ 100, it looks very similar to the S&P, except it hasn't pulled back all the way to its 50-day moving average. It's still hovering below an all-time high that it recently hit, but it's just kind of digesting those gains and grinding sideways right now. But again, if we get to gold, as I mentioned, gold is back down to that $4,000 level. And you got to realize we haven't been there for about 6 or 7 months. We got up to the $4,000 level back in October and around that time. And then since that, of course, that led to a big, massive rally that led us all the way up to $5,600 on the price of an ounce of gold. Well, we've come back down now. We're back in that $4,000 range. To me, this looks like an attractive time for accumulation. If you are a patient long-term investor and you want portfolio insurance like I do, I like to add gold on weakness. For my long-term portfolio, I consider it portfolio insurance. I don't think I'm going to get rich from gold. I never want to ever have you think that, but I do think that it can be a good store of value, and that's why we continue to own it. But the price of physical gold did slip through its 50 weekly moving average, and that's a really key level. Right now, that's probably the big area I'm watching on the charts. To reclaim that area, we have to go back up to around 4,300. If we do that soon, then we could see this current trend or this current weakness in gold turn around. But right now, it looks like we're heading down. Looks like the path of least resistance right now on gold is to the downside. Right now, major support areas around the 3,850 level, 3,800 or so. We'll be watching that closely. Right now, if you're curious between gold and silver right now, gold is still offering a better opportunity if you look at the gold-silver ratio. Right now, it favors gold, even with the pullbacks we've seen in both metals. Also, let's talk, we've already talked about the dollar, which has really been back on a tear. Again, watch out for around that 102 area on the US dollar. We're currently about 101.50 on that level. Watch out for a breakout above 102, which again could signal more upside ahead as investors begin to anticipate that future rate hike. Also, if you look at small caps, boy, they've really been doing great. A lot of rotation has been moving into small cap stocks, which have been beaten down for so long. The Russell 2000 hitting fresh record highs pretty regularly now as it continues in its nice uptrend. This one has been looking really nicely. The Russell and the NASDAQ both having very good years so far year to date. China, meanwhile, has been struggling. We've seen their stock market come down quite a bit. We like to follow China with the S&P China ETF GXC. It's a really helpful metric for tracking over 1,000 of the most important Chinese equities, but it suffers from extremely low volume, and that makes it not an ideal trading vehicle. However, it can really help you know the overall trend in the Chinese market. And right now, that one's in a downtrend, a very confirmed downtrend right now. We already talked about silver a bit. We were wanting to see silver hold that $60 level. It has broken down below that level, and so now there could be more downside. the next area we'd be watching on this particular chart on silver, it would be around, probably around the $55 level. There does seem to be a little bit of good support there. We'll see if that can hold. If not, maybe around the $52 level. So we could still see more downside ahead on silver after we saw that epic rally. Also, silver, like gold, has fallen below its 50 weekly moving average, another very key level. That currently is sitting at around 63.50. So if we can regain that 63.50 level, that would be bullish for silver. But right now it appears that's going to be operating as kind of a ceiling on the price of silver. Oil, as I mentioned, has come down greatly, dramatically, quite frankly. West Texas Intermediate is back below $75, which is a key level we constantly watch. Also, Brent crude is back down below $85, which is exactly what we wanted to see. So these, oil is really back in a place where we feel like it could be manageable and it could stop contributing to the elevated inflationary pressures we're continuing to face here in the U.S. Finally, before we wrap up this segment, let me also just briefly comment on Bitcoin, which, by the way, at current levels, I'm extremely bullish on. I'm putting out a note to our members this evening where I'll be talking more about Bitcoin. I've got some charts I want to share and all of that. But let me just say that at current levels, we are sitting at one of the very best areas on the chart, historically speaking, and that is the 200 weekly moving average. Bitcoin has pulled back to that area. Now, I've been investing in Bitcoin since 2012, and every time we have been at the 200 weekly moving average, I've always bought. That's always been one of my favorite places to buy. We are at that level again. We haven't been there since 2023. The last time we were there was in 2020 during the COVID crisis. So we are at an area that historically has been a good risk-reward ratio if you were to buy and you had a longer-term time frame, not buying it today and then expecting it to go up tomorrow. But if you had some time, this is often a very good place. Now, here's the other thing, is that when the price comes down to this level doesn't always hold. Sometimes it goes below that level. And if it's below that level, that makes me even more excited as a long-term investor. So I am very bullish on Bitcoin here. Not that I'm saying it's going to go up next week. I don't think we're going to see Bitcoin really bottom. It may have, but I don't think we're really going to see it bottom until maybe a little later this year. It appears from our research that we're going to see the next bull market emerge by October. That seems to be what the cycles are and the analysis is telling us. If we get a dip down to $50,000 on Bitcoin, that will put us in what we call the extreme value zone, which represents a 60% decrease from the former peak. That would be, in my opinion, even a better place to buy Bitcoin. But right here where it's at historically has worked out every time in the past. Of course, past is not prologue, but those are our thoughts. Also, one more comment on Ethereum. We've stated over and over on Ether, I should say, is that 1750 is a really key area. We're trading below that now. We've been struggling around that area throughout late May and June so far. That's an area where we're watching closely. When we're below 1750, we have been buying and adding to ETH in our long-term holdings. We like that project despite all of the noise around it, despite all of the noise we're hearing about the Ethereum Foundation and the layoffs or the people leaving. We are still very bullish on Ether for the long term, and we like this present weakness in the price. And we are taking advantage of it. So there's a little bit of what we're seeing in the markets. I hope that's been very helpful to you. On the other side of this break, we're going to wrap up today's episode, and we'll leave you with a final word. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. And before we wrap up, let me leave you with a quote from Warren Buffett that I have always appreciated. It goes something like this: "Someone is sitting in the shade today because someone planted a tree a long time ago." I think that's a wonderful picture of what investing is really about. You know, the decisions that we make today often benefit someone years or even decades into the future. When parents or grandparents begin investing for a child, they're planting a tree. They may never personally enjoy all of the shade or fruit from that tree, but one day that child could. Whether you choose a Trump account or a kid Roth IRA or a 529 plan or some other investment account, that really isn't the most important question. The bigger question is whether you're planting anything at all. You know, one of the greatest gifts we can give a child isn't money, it's time. And while we can't give them more time to live, we can give their investments more time to grow. And that's one of the beautiful things about getting started early. A few dollars invested during childhood can accomplish far more than many people realize because those dollars have decades to work. I also hope we remember that our greatest inheritance isn't measured only in dollars, it's measured in the values we pass along. Teaching our children to save before they spend, teaching them to invest before they consume, teaching them to have a producer mindset as opposed to a consumer mindset, and to own productive assets instead of chasing all the latest fads, or to be patient when everyone else is in a hurry, and to understand that wealth is a tool for serving others, not simply accumulating more for ourselves. Those lessons may ultimately become more valuable than the account balance itself. And that is just something to think about. Well, friends, thank you so much for joining me today. And if today's program was helpful, please share it with a parent or a grandparent or anyone who is thinking about giving the next generation a financial head start, especially for those who may have a child on the way, who are planning to have a child soon. They could really benefit from this episode. And if you'd like to explore whether a Trump account or a kid Roth IRA, a 529 plan, or some other strategy makes sense for you and your family, just request a complimentary conversation with one of our affiliated advisors by visiting followthemoney.com/advice. Until next time, friends, remember to live with purpose and invest with wisdom. And as always, follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.